Hello, everyone. Good afternoon. Welcome. You all are tuning into Smart Credit Strategies for Small Business Owners in partnership with NAV and Small Business Majority. My name is Rachel Shanklin, and I am the Senior Director of Education and Resources here at Small Business Majority. A couple of housekeeping items. This webinar is being recorded, and you will have access to the recording and slides once the webinar concludes. These resources will be sent to the email you registered for the webinar with. I'd also like to take time to thank our partners at NAV and NAV's education consultant, Gerri Detweiler, for being here with us today. Additionally, we will have a Q&A at the end of the presentation, so any questions you have, please add them to the Q&A function or the chat box, and we will be sure to get to them when we conclude our presentation. Before we dive in, just a little bit about our organization. We are a national business organization with a network of over 85,000 businesses and 12 offices across the country. We focus on advocacy and educating small businesses with resources in partnership with over 1,500 business organizations. Since our founding in 2005, Small Business Majority has actively engaged entrepreneurs and stakeholders in support of solutions that promote small business growth and drive a strong economy. We connect entrepreneurs with the information and resources they need to address the biggest issues facing their small businesses, including access to responsible capital, healthcare, fair competition, and other policies directly impacting entrepreneurship. We serve all entrepreneurs, but focus on reaching under-resourced entrepreneurs, including women, people of color, immigrants, and those in rural communities. Lastly, we serve as a hub that connects small business owners with the education and resources they need to start, grow, and sustain their business. Additionally, we work at the national, state, and local levels to promote public policies and support and build ecosystems that ensure entrepreneurs are able to access the right resources at the right time without barriers. Here is a map of some of the states that we work in. We are a national organization, but this is where we have some folks on the ground. And then one other resource I'd love to share before we dive into our presentation is venturize.org. Venturize.org is a free online resource hub designed to help small business owners navigate access to capital and financial resources. Powered by Small Business Majority, Venturize offers unbiased education on small business financing, including guides on responsible lending, credit building strategies, and funding options. Entrepreneurs can explore interactive tools, expert advice, and tailored resources to make informed financial decisions. Whether you're seeking a loan, improving cash flow, or preparing for growth, Venturize.org empowers small business owners, especially those from underserved communities, with the knowledge and support they need to succeed. So as I mentioned, you can find business essentials, loan and grant assistance, workplace benefits, as well as events and educational videos. You can also find resources to start your business roadmap, getting loan and grant ready, types of healthcare plans, retirement, and workplace benefits like healthcare and paid family leave. So that's all for me, everyone. Feel free to connect with me on LinkedIn. Shoot me an email if I can ever be a resource to you. We're here for you as small business owners. And with that, I'm going to pass it over to my colleague, Gerri.
All right. Thank you so much, Rachel. I did see a message from someone who said they couldn't hear. I am hearing just fine. So hopefully, maybe it's just a mute button on your end. But if anyone else cannot hear, please let us know because obviously we don't want you to miss anything. So thank you again to Rachel and Small Business Majority. I have been a long time Small Business Majority fan and follower, and the resources that they put out are just fantastic. So if you're not, it's like one of the few, I would say, handful of small business newsletters that I just never miss. I always read it when it comes to my inbox. So I hope you'll consider doing the same. And I appreciate your having us here today. Okay, so we're going to talk about smart credit strategies for small business owners. And again, I'm Gerri Detweiler. Just really briefly on my background, I've been in the credit field for what feels like forever, since before consumer credit reports were free. And when you had to actually go to the credit bureau to get your credit report before anyone knew what a FICO score was, except for maybe people who worked at FICO. And then I shifted to focus on business credit and credit for entrepreneurs about 12 years ago with my book, Finance Your Own Business. And since then, I've been doing a lot of work with NAV. So I am here today on behalf of NAV, and I'm delighted to do that. I'm also bringing my own experience in this industry here. So ultimately, I am responsible for what I tell you, and I will do my best to give you helpful information that, that helps you reach your goals. So here's what we're going to cover today. Why credit matters to you as a business owner, and we're really focused on the business owner today. The main credit scoring factors, and this is focused on consumer credit largely, strategies and action steps for each of the types of information that may be impacting your credit, and then some tools and resources. And I do want to emphasize NAV does not provide legal or financial advice, and NAV is not a credit repair organization. So we will touch on credit repair near the end, but that's not really what we're here today. We're here to help you understand how to leverage and build and manage credit as a business owner to help you get the financing and other opportunities that your business may need. And I will take questions. So you can throw those, I think into the chat, unless Rachel tells us otherwise, you can put them in the chat. We have someone from the NAV team, Amanda, here to moderate at the end. So don't hesitate, just throw those in as you think of them. All right, so let's start with the whole concept of why this is so important. Why do business owners need to worry about the personal credit? Because ultimately, if you start a business, you hope to completely separate your business and personal finances and not have to worry about personal credit or your personal finances getting mixed in there. The reality is a little bit different, and it's especially different for smaller businesses, newer businesses, and businesses without, a significant number of employees and revenue. So the Federal Reserve surveys small businesses every year for the Small Business Credit Survey, and they haven't asked this question in a few years. This was from 2020, but they asked the business owners, "Hey, when you applied for credit this past year, is your personal credit, your business credit, or both?" And you can see from this chart that only 12% said they just use business credit. 40% said I only use my personal credit, and 48% said they used both. So both business and personal credit is often important for business owners. So we've talked before about the business credit side, and now we're going to shift focus a little bit to the personal credit side and how that information plays into your financing opportunities. And speaking of financing, that's where a lot of business owners really find out about the fact that their personal credit is part of the equation, because there are a lot of different types of financing that typically or may check personal credit in addition or separate from business credit. Now, a lot of times when online, for example, they may offer a soft credit check. We'll talk about those in a moment. And they'll offer soft credit check when you're just trying to find out if you qualify. And then if you say, yeah, I like what you're offering me, I'm going to apply. That's the point where there may be what's called a hard credit check. We'll go into that in more detail again. But you can see from this graphic here that there's a lot of different types of financing where a personal credit check is not uncommon. All right, so how does the system or the ecosystem work? There are three major consumer credit bureaus: Experian, Equifax, and TransUnion. They're the companies, they're private for-profit companies. They don't share information with each other unless required by law in a few circumstances, like fraud. And they collect data about how you and I handle our personal finances, largely our credit accounts. And they compile those into credit reports. And then sometimes they will create their own credit scores, but for the most part, these companies partner with companies that do the credit scoring part of the equation. So a lender, for example, might go to Experian and purchase a credit report that also comes with a FICO score, and FICO provides the formula behind that credit score. Or they might purchase one that is a VantageScore. And VantageScore is the competitor to FICO that was started by the credit bureaus a little over a decade ago. So they might purchase a credit score from VantageScore. It depends on what they want. But for the most part, these credit scores that are used in the decisions that these lenders are going to make about you or your business are going to come, from calculations by these external companies. Similarly, You cannot, a lender can't go to FICO and buy a credit score because FICO doesn't have any credit data. They have the formula, and they would have to go to a credit bureau or use their own internal data to purchase a FICO score from FICO. So I just want to make that distinction because I think it can be confusing, especially when people ask me, like, what's my real credit score? Or what's the best credit report to get? We'll talk about that in a moment, but it can be confusing. So that's the basic landscape. Now, let's ask a question real quick, and you can throw your answer into the chat. How many personal credit scores do you think you have? How many credit scores do you think you have? Anyone want to guess in the chat? Okay, let's see. We've got three, two, five, many. Okay, three. Yep. Yep. Those are all great responses. The most common response I get is three, and that makes sense because you have three credit bureaus, right? Equifax, Experian, and TransUnion. And then sometimes people will say six because you've got the two companies, VantageScore and FICO, multiply that by three, right? So you get to that. But the answer is many, many, many. There are over 50 versions of FICO scores alone. Now, VantageScore has fewer versions. We'll talk about in that moment, but there are over 50 versions of FICO scores. So don't let this completely cross your eyes. But you see, a lender can say, "Hey, we're going to this here." I'll give you the explanation where this often comes into play. You are checking your credit score. Let's say your credit card company gives you a free credit score. So you check it with your credit card company, and then you go into the auto dealer, and the auto dealer pulls a different credit score. And one reason is because they could be using a different credit bureau, right? You could be checking it with Equifax, and they could be pulling it from TransUnion data. The other more likely scenario is that you're checking your credit card credit score, which is probably a bank card score, and you see several versions up there, and they're checking an auto score. They're checking a different type of scoring model. And because it's designed to make a little bit different credit prediction about how you handle auto loan versus a credit card, it's a little bit different. So I want you to understand that because, again, like I mentioned, you get the question about which credit score is accurate, and it can be a very confusing question for many people. So, given that question, I'm going to let you guess on this one too. What do you think is a good personal credit score? What do you think is a good personal credit score? So, we've established that there's these different models that lenders have their choice of going to the bureau and choosing the model of FICO or VantageScore that they want to use in their credit decision. And by the way, you won't encounter VantageScore much in the business lending environment. FICO is more common in the business lending environment. VantageScore is really focused more on consumer credit decisions, just so you know that. All right, so let's see what we've got. Some answers here. 675 and above, that's great. 780, 750. Okay, those are all excellent, excellent answers. And my answers, I'm not trying to be cute here, but the answer is it's what the lender wants, like what the lender considers a good credit score, because each lender will have its own credit score ranges and credit score cutoff. Now, very rarely, if you have a credit score above 720 or 750 on the consumer side, again, they run to 850, you're probably not going to have any trouble, getting probably approvals based on just the credit score, right? There will be other factors, but you probably won't have trouble getting approved based on the credit score. And you will probably fall into what's called a prime tier, where you're getting offers for the better interest rates, for example, or the better terms, because usually credit scores in the mid 700s or above are considered very good. Then as you move down the scale, 680 for some lenders, that's perfectly fine. For other lenders, that might be considered fair credit. Once you get to 650, you're typically falling in something like a fair credit score range. But again, some lenders are perfectly fine with that. Others may want to see a higher score. So it really depends on the lender and what their ranges are. For FICO, the range is 300 to 850, with 850 being the lowest risk number that you can get to, the best credit scores. I'm saying in air quotes because it's the highest number that you can get. There is a version of FICO called Next Gen that it's not used super widely, but there is at least one major credit card issuer that uses it. And it ranges, the high cutoff score is either 935 or 950. And I bring that up because if you have a card with this issuer, and I'm pretty sure this is still, I'm not going to name it because I haven't double checked it today, but if you're checking your credit score through your credit card issuer, you see a score that looks higher than anywhere else you're checking, it may be the range. So I always encourage consumers when they're checking their credit scores, business credit scores, or personal credit scores to look at the range to see where you fall in the range, not just the number itself. VantageScore, the current versions, and they're very popular with lenders. Today, I say version 3, from what I understand, is still the most popular version. That's also 300 to 850. But before that, there were VantageScore ranges that went up to 990. So again, just check the range when you're checking your credit score. That may help you identify where you fall in terms of that score. All right, so now we're going to shift gears a moment. We're going to talk about the basic formulas and more specifically, what types of actions you may be able to think about if you're trying to work on a particular area of your credit. Now, this is what's known as the FICO formula, and it's FICO's way of giving you shorthand of the most important factors in your credit score. So the largest is payment history. The next is how you use debt. The third is the age of your credit history or the length of your credit. And then that's followed by account mix and inquiries. And we'll go into each of these factors in just a moment. And then this is the VantageScore formula. So it's pretty similar. It's a little bit different. This is VantageScore 3.0, but it's got your payment history, then your depth of credit that includes things like credit, the mix of credit you have, how you're using the cards that you have, your balances, recent credit, and available credit. So it's kind of similar, but it does have a few differences. And I also bring up that because you may be checking your credit somewhere where you're seeing a Vantage score from one source and a FICO score from another, and you wonder why there's a difference. Well, again, it could be the bureau, could be that the bureaus that you're checking have a little bit different information, but it also could be that they're using a different credit scoring model that weights things a little bit differently than what you're seeing from one source to another. So let's touch on payment history. And by the way, I am going to give you a resource at the end that is completely free that will give you a worksheet with all of this in it. So you, in addition to getting a follow-up email from Small Business Majority with the slides, so you can review those again, and we will be working on getting the recording too as well. We will have this guide available, more of a workbook format that can help you walk through these steps. So let's talk about payment history. This is things like, do you pay on time? Do you have accounts in collection? And do you have bankruptcies? Those are the big collection accounts, bankruptcies, charge-offs. I'll explain those in a second. So that's the main factor. Now, when it comes to your late payments, there there are a few ways that the scoring models look at them. And one is recency. How recently did it happen? And if you've looked into this issue at all, you might have seen that someone with a great credit score misses a payment, and their credit score usually will drop more than someone who maybe doesn't have a great credit score. The impact will be bigger. And FICO's put out some scenarios that share this type of example. So recency, like when that negative information is it 1 month old, 3 months old, 9 months old, 2 years old? That matters. How often did it happen? So I had a banking snafu a few years ago. I closed an account and my mortgage company still auto drafted well, I didn't close it actually. They changed. The bank changed from one name to another, but the information changed. And so the bank went to, process my account and it didn't go through. So I was late on a mortgage payment. And of course, I freaked out. But honestly, because it was one time, it didn't have the kind of impact that it might have had I been falling behind and have several late payments in a row. Severity is another factor. So that is, were you just 30 days late or were you 120 days late? Obviously, the more those delinquencies drag out, the more that can impact your credit scores. The one that doesn't typically matter that much, at least with FICO scores, is the amount. In other words, if you miss a $10 payment or you miss a $1,000 payment, that's not the main factor in this particular calculation. It typically, the main factor is, how recent was it, how frequent was it, and how severe was it. So we'll talk about some strategies that go with that in just a second. You also want to understand how long negative information can stay on your credit reports. This has been tightened up in recent years with changes to the Federal Fair Credit Reporting Act, the law that governs, how credit reporting agencies collect and report and handle disputes. So there used to be some scenarios where information could basically stay on your credit report forever, and they've closed that loophole. So now it's 7 years for late payments and a Chapter 13 bankruptcy. That's where you pay back your debts over time. And then that's from the date you file for bankruptcy, not the date it's discharged or ended. And then collection accounts go for 7 years and 6 months. 7 years and 180 days is actually how the statute reads. And that's based on your original date of delinquency with the original creditor. So this is important if you have collection accounts. So you fell behind on your credit card on January 1st of 2020. That is that you were 30 days late in January 2020. That's when that starts. It doesn't matter how long they waited to turn it over to a collector. It doesn't matter if another collector picked it up 6 months later because the first one couldn't collect. That original date of delinquency is key. And so keep that in mind if you're in a collection situation, because sometimes they will make it sound or lead you to believe that it could stand there a lot longer if you don't pay it. And that original date of delinquency is the gospel as far as, how long it stays on your credit reports. And then Chapter 7 bankruptcy, that's a straight bankruptcy where you wipe out most or all of your debts. That one can stay on your credit report for 10 years. Now, legally, the Federal Fair Credit Reporting Act doesn't make a distinction between the two types of bankruptcy, but the credit bureaus voluntarily will remove a Chapter 13 bankruptcy 7 years from the date of filing to, give you some credit, so to speak, for having paid back some or all of your debts in a Chapter 13 bankruptcy. Now, what you probably won't find on your credit reports anymore are judgments and tax liens because most credit bureaus, well, the credit bureaus for the large part have stopped reporting those. There was a problem with the accuracy and the dispute process with that information, so it's pretty much not reported now. And then collection agencies, there are some major collection agencies that now will upfront agree to remove or not report the collection account if you either get on a payment plan and stick to it right away, or if you pay it off within a certain period of time. It varies by collection agency. But if you're dealing with a collection account on your credit report, I would do some research on this because you could use that as potential negotiating leverage if you're trying to work out something with a collection agency. All right, so what do you do about payment history? So the first thing is you just wait because time does time can help. I can't say always does, but it can help. And the reason it can help is because that aging process that I mentioned, as information gets older, it has less impact on your credit reports. And so tends to have less impact on your credit scores. So just waiting and working on making sure everything is paid on time going forward, that alone may be helpful to your process of reestablishing your credit. Paying on time, though, of course, is going to be extra critical, especially if you have this negative information in the past, but really just paying on time in general, because as I mentioned, you can have a great credit score, you accidentally miss a payment, and then your credit score drops. So I I almost learned this one the hard way. And so I now have at least my minimum payment set up on auto pay for everything. Like I do not do anything without the first thing I do when I get a credit card is set up the minimum payment on auto pay because I was once on vacation and I remembered, oh, I need to pay this credit card. So I went online, you know, put how much I wanted to pay, which bank account I wanted to go through, and then I don't know if you've experienced this, but you put that all in, you click the button, and then it takes you to another screen that says, are you sure you really want to pay this? Well, I think I skipped that second screen and I came back to a notice from my credit card company that my card was still unpaid, that I had not made my payment. So it's just safer if possible. I know that's not always feasible, but if it is feasible to set that up so you don't accidentally miss a payment and see your credit scores drop. And then we talked about debt collectors, negotiating with debt collectors. If you are dealing with collection accounts on credit reports, I'm happy to share a couple of resources. I had actually written a whole book about this. It's not currently in print, but I'm happy to share some resources with you so that you can try to make sure that you navigate that in a way that doesn't end up hurting your credit. And then dispute mistakes. So if you have mistakes on your credit reports, you have the right under federal law to dispute them. The credit bureau has to investigate, get back to you, and either stop reporting it if they can't confirm it or tell you why they're going to continue reporting it. And this is really the heart of what credit repair is largely about. So we'll talk about credit repair in a little bit, but that's one of the things that they do in abundance, maybe sometimes overabundance, and that's something you can absolutely do yourself. All right, so the second most important factor in FICO scores is how you use debt. And largely, it's going to focus on your credit utilization, which is a comparison of your balances on your revolving accounts, like your credit cards, to the credit limits. So your credit report says your credit limit is $1,000 on this credit card. Your card issuer reports a balance of $500. That's 50% utilization. It is based on the information as it's reported on your credit reports now by your creditors. Now, one thing I love about this factor is that it is one that can change quickly. And we'll talk about some of those approaches. Unlike something like you have a late payment, it's accurate, you've tried disputing it, it's not getting removed, you're kind of stuck with it for a while, right? Credit utilization is something that can change quite quickly. And I've written a few articles where I've showed examples of, people I know who have seen their credit utilization affect their credit scores by 40, 50. The highest I've seen is 100 points very quickly. So that might give you a little bit of hope that this is something you want to take a look at if it's impacting your credit scores. It may or may not be, but I'll ask you another question. What's a good utilization rate? Anyone want to guess? Okay, 30%. I'm seeing a ton of 30%. Matthew, I'm seeing a 20%. Yes. So again, there's no magic number for this one. Uh, but FICO says that consumers with the very highest credit scores use on average about 10% or less of their available credit. You may not need to go that low, though. What seems to be one of the ways this is impacted is it depends on how extensive your credit history is. So, for example, I'm older. I have a long credit history. I have lots of credit accounts, lots of credit experience. My credit utilization creeps up to, 40 or 50% because I'm making a big purchase or something. I don't usually see it move at all. But one of the people I interviewed was just building credit, young, only had a couple of credit accounts, short credit history, and he saw his credit utilization make a big swing on his credit scores. So, one thing I'm going to recommend is when you check your credit reports and your credit scores, look at what that is telling you about the top factors that are impacting your credit. Sometimes those reasons are helpful. Sometimes they're a little bit obscure and not that helpful, like no balance on a retail account. Well, you don't have to have a balance on a retail account to have a good credit. In fact, the better your credit, the more those factors are going to be a little bit, you're going to wonder about them because they're trying to tell you, the most impact. And if you have a great credit score, it's harder to tell you what's really, making the biggest impact on your credit scores. But the 30% is a good rule of thumb. And some of you may be hovering on, let's say, one card at a higher utilization and another card a lower utilization. I want to address that real quick. Let's say you have a card that's at 50% and then you have cards that are 20%. Um, the credit scoring model can look at it individually as well as in the aggregate. So that one card with a very high utilization could throw off that score. It could throw off your score because it's high and it's bringing it down. There are times when that may make sense financially to do that. For example, you transfer a balance. You get a 0%, you transfer a balance, you have 60% utilization. Just be aware this could happen. This could affect your credit scores, and just think about what you're doing next with your credit journey so you know that that could be a potential way your credit score could be impacted. But let's say you don't have a big major loan coming up and all you want to do is you want to work on your credit. You checked your credit score. It said that you have high utilization. So you're like, I'm going to start bringing down my utilization. So what might work for this? First is to just pay down balances. If you have the cash and you can pay down your balances, that could make a difference. Now, I do want to talk about the timing here because this is really, really important. They do not care when you make your payment. What the credit bureau is working with is the information on your credit report. So, most likely, your credit card company will send the information about your balance over to the credit bureaus around the time that they send you a bill. So they close out your billing statement, and on your statement or in your online portal, you should have a statement closing date. So let's say your statement closing date is the 18th of the month. Around the 18th, they send you, they notify you online or they send you a bill in the mail if you prefer that. And it says, you owe us $3,525. You can make the minimum payment of $74, or you can pay it in full, or you can pay the last statement balance, etc. That's typically when they report to the credit bureaus. They don't wait to see how much you're going to pay by the due date. And so that timing can be very useful for you as you think about this. And if you're not sure, just pull your most recent, well, I go back maybe a month, pull your statements from your credit card companies and then look at your credit report. I did this recently just to match things up, make sure I was still on track, that nobody had changed any major policies. And I have cards from 4 major issuers. And sure enough, all of them reflected the statement balance, the balance that they told me I owed at the end of the billing cycle. That was what was on my credit report. So that could be very different than after you make a payment. So paying down your balances can be great, but also paying earlier may be helpful. So if you're someone who pays in full each month to try to avoid interest, for example, going online, you have a month where you've had a major purchase, maybe you're investing in your business, maybe you used a personal card for some of your business purchases, and you have that high balance. Maybe you go in like 5 days before the billing statement closes and make that payment instead of waiting till after, the cycle closes to make that same payment that you were going to make anyway. That might bring down the utilization that's reported depending on the reporting cycle of the issuer. And it really can sometimes make, quite a difference just in terms of when you actually send in that bill. Now, another tip here, which is not on the slide, but I'll add it, is that many small business credit cards do not report to personal credit unless you default. Many of them do report to one or more of the major business credit bureaus, but not to personal credit. So that can be another way to keep this away from affecting your personal credit. And let me tell you a quick story here. I was at an event and a small business advisor told me about one of his clients. She had some financing fall through at the last minute. So she went ahead and maxed out her credit cards because she had an opportunity that she wanted to take advantage of and she couldn't get the financing fast enough. Her credit scores plummeted because she used both personal and business credit cards. Within a year, her business was doing just fine. She was making money and she was actually able to refinance that with a business loan that did not show up on her personal credit. So she paid off those credit cards that she had used for her business. And he told me her credit score jumped over 100 points as the result of this, just moving that debt away from personal credit. So I don't recommend use a business card for personal purchases, but it's something you definitely want to consider for business purchases in terms of trying to fully separate your business and personal finances and your business and personal credit. You might also call your card issuers and see if they can raise your credit limits. Higher credit limit gives you more room there. And then you could also consider refinancing. So what happens here is if you have personal debt that's high on a credit card, you pay it off with a personal loan. Let's say you get a personal loan for 5 years and you're going to pay a fixed amount each month. Personal loans are typically considered installment debt, not revolving debt. And so, not always, but typically. So, you do want to check that. But with installment debt, you're paying back a certain amount each month until the debt is paid back. And installment debt doesn't handle utilization the same way. So, while that debt may have an impact on your credit scores, it doesn't fall under the same calculation as revolving debt utilization does. And so what you may see that help, with your utilization ratio, which in turn may have an impact on your credit scores if that is affecting your credit. So those are a few strategies to think about. But again, I'm talking about this one a little bit more detail because it is one of those things that um, doesn't rely on you trying to dispute accurate information. It doesn't require you to use credit repair. It's just trying to manage your cards a little bit better and figure out the right way to do it. So hopefully you can see better scoring on that front. Now, the next factor is credit age. I think we mentioned this is about 15% of your credit score in the FICO formula, and it is a factor in VantageScore as well. So with FICO, they look at the oldest account, when was it open, the youngest account, when was it open, and then the average age of all your accounts. So here you get credit for having an older, longer, more rich credit history. It's valuable. But it's also one of those factors that's hard to fudge. I mean, you started getting credit when you started getting credit. So you could go out today and say, well, I'm going to start building credit, and you'll start the credit age there. So it is one of those factors that's important, but it's a little bit trickier. And I'll give you a couple, thoughts there. The first is to be patient. So again, as time goes on, these accounts, build a credit history and establish credit age, which in a FICO score and even a VantageScore is a good thing. You do want to think about opening new accounts carefully. And we're talking about accounts that will appear on your personal credit because of that average I told you about. Now, I will tell you, I have friends who are into the whole travel credit card hacking thing who have dozens of credit cards and have great credit scores. So it's not going to necessarily, I feel like I have these two groups of people I know. One who says, I can't open a new account because it's bad for my credit. The other group who says, oh, what's the welcome bonus? If it's good, I'm going to open the account. So what I'm suggesting is you just understand that this factor will impact your credit score. When you apply for new credit, there's probably going to be an inquiry. We'll talk about those. And then you probably, you will see that affect the credit age. So just be smart about it. Like, open something that you really want. When my husband, goes to a store and gets a retail card for a 10% discount on a $100 purchase, I'm annoyed because I'm like, that's not worth it. You need to really open a credit to make it worth it. So just be thoughtful about what you decide to do. Don't freak out and feel like you can't apply for any new credit. because it's going to drop, it's going to ruin your credit score, but at the same time, apply for stuff for credit that you really want and hopefully that you're more likely to qualify for, that you're not just doing what car dealers sometimes do, known as spray and pray, right? And sending out lots of applications, hoping something gets approved. Now, the third strategy that comes into play here a lot is what's called piggybacking, borrowing good credit. So here's where someone adds you to one of their credit cards as an authorized user, and then you benefit from their credit history. So an example would be my daughter when she, started driving at age 16, I added her to one of my credit cards, and the entire account history went onto her credit report. So it looked like she had started getting credit when she was 6 years old, which was not the case, but the whole account history was on there. It's a strategy that sometimes can be helpful. Just remember, this other person's credit history is going on your credit history. So if they don't pay on time or if they have high utilization, that will go on your credit report as well. And it's difficult to separate. It's not impossible, but it's difficult. So just be very, very careful if you decide to go this route. Someone you really trust, has excellent credit, always pays on time, keeps their balances low. That's the kind of account that might be helpful for you in terms of establishing credit age. But if you don't have that opportunity, don't worry about it. These other things we can talk about are things you can attack. Okay, account mix. So you tend to have a better credit score if consumers tend to have better credit scores overall if they have a mix of different types of accounts. So another example here, my dad a few years ago got a letter from his auto insurer saying you didn't get the highest discount on your auto insurance policy because of your credit. And he's pays his bills on time. He's very conservative with credit. The problem is he doesn't have much credit on his credit report. His house is paid for a long time. His cars are paid for, just a couple of credit cards. So his account mix wasn't robust there. So here it looks at your revolving accounts, again, like your credit cards, installment accounts, which could be mortgage, car loan, student loan, auto loan, things like that. And then open accounts, which might be like charge cards where you don't have a set credit limit or you just pay, you pay daily or weekly or monthly on those accounts. That's the third category of accounts. So consumers who have a broad mix of credit tend to have, better credit scores. Now, this does not mean you have to run out and get an auto loan or a mortgage if you don't want one. Now, I'm going to give you a couple of alternatives here. First of all, on credit cards, if you're nervous about debt and you don't use credit cards, you use debit cards, you might want to think about perhaps considering a charge card. A charge card requires you to pay in full each month, but it falls under that, category. So it may be helpful for establishing your credit. Or if you can't qualify for a credit card, you might want to consider a secured credit card where you put a deposit and then based on that deposit, you get a credit card. Just be careful with secured cards. I've seen people get them, then because the credit limit is so low, they end up maxing them out and then their utilization is 75% and that breaks down their scores. So be very careful if you have a low limit credit card to start. And then on the other side, for the installment accounts, you have credit builder loans. So these would be accounts where you're building up savings and it gets reported. And then when you build the savings account to a certain level, you get the money in the savings account. Those typically report as installment accounts. So if you're lacking an installment account and you don't want to, and you see, you get a notice with your credit score saying lack of installment accounts, and you're seeing that it's, definitely impacting your score, that might be an option you could consider so that you don't have to go out and get a debt that you don't necessarily want to get. So again, credit builder loan, you're saving toward an account that you will get when you pay it off. And the payment history, if it's reported to the credit bureaus, can provide an installment reference on your credit reports. All right, last one, inquiries, then we'll take some questions. Okay, so inquiries are just a record of who has checked your credit. That's it. Doesn't say whether you were approved or denied. And it also appears only on the bureau that was checked. So if you're not going for a mortgage, for example, chances are the creditor is going to check one bureau. They're going to check Experian, Equifax, or TransUnion. They're not going to check all three unless, again, it's a mortgage where they almost always check all three. Um, and then not all inquiries affect the credit scores. And we'll talk about that in more detail in just a second. So I'm bringing this up because I do often see people very nervous about inquiries. And I do think you need to pay attention to this factor, absolutely. But it's not always as big of a deal as other things that you may want to work on your credit. So let's go through those inquiries that don't affect your credit scores. Anyone want to guess what type of inquiries don't affect your credit scores? No guesses? Soft inquiries. Okay, thank you, Daryl. I appreciate that. Yes, yes, Matthew, soft inquiries. Yes. Micro, okay. All right, so let's go into the soft inquiries because that is the correct answer. Soft inquiries don't affect your credit scores. So, soft inquiries are every time that someone checks your credit, by law, they have to tell you on your credit report they did that. This is federal law. They cannot not tell you that your credit was checked, but they don't have to show those inquiries to everyone else. So soft inquiries are ones where you will find out about it, but the other creditors and the credit scoring model won't know or won't take that into account. So this is like you check your own credit. You're using NAV, you're using Credit Karma, you're using your credit cards, free credit score service, whatever it is. That doesn't affect your credit score. Promotional or pre-approved offers that you get where you're sent something in the mail, for example, or in your app on your credit card issuer's app that says you've been pre-approved. Those don't affect your credit score. Employment credit checks, those are only credit reports. Employers don't check credit scores. Insurance, so like my dad with his auto insurance, that doesn't affect your credit score. And then account review depends. So if you call your card issuer to ask for a higher credit limit, it may or may not be a soft inquiry. That may be something you want to ask about. Now, even if you do end up with these inquiries on your credit report, there is this thing called the buffer that, or dedupe, they call it deduplication, where certain inquiries may be grouped as a single inquiry. So, for example, with FICO, what they do is they group either auto loan, mortgage, or student loan inquiries in a short period of time, and they count them as one. So, unfortunately, the models vary on the time period. So some models are 14 days and some are 45 days. But let's say you do go auto shopping, you end up, the dealer does send your application to a bunch of places. Under FICO's models, it's supposed to only count as one inquiry if it happens in a short period of time. There's some older models that are actually still used in the mortgage industry, though, that don't do this. So if you're going to get a mortgage within the next few months, talk to your loan officer before you do any kind of credit changes or shopping or disputes at all. Make sure you have a mortgage loan professional who knows credit and you talk to them because you don't want to mess that up. They're just using a very, very old model in many cases. Now, the other good thing about inquiries is they only stay on your credit report for credit reports for 2 years. Unlike the negative information, it can stay on for 7 years. It's maximum 2 years, so that's good. It's gonna drop off your credit report automatically. You don't have to do a thing. And they typically only impact credit scores for 1 year with FICO scores. VantageScore says it can be up to 2 years, but again, recent information tends to carry the most weight. So a friend of mine recently, went shopping for an auto loan. She ended up with inquiries and she said, my credit score dropped. What am I going to do? And I said, wait. And sure enough, 2 months later, her credit score had bounced back. I'm not promising that will happen with you, but I am suggesting that these impact, again, it's like the more recent it is, the more impact it tends to have on your credit scores. All right, so what can help? You wait, right? Like my friend did. You just wait. You do apply carefully. You choose what you want to apply for. And if you find inquiries that are fraudulent or you don't recognize them, you have the right to dispute them under federal law. I will say there was a recent article, I think it was in the New York Times, talking about how, you know what, it was a ProPublica story about how disputes are not getting resolved as quickly as they were a year ago because the Consumer Financial Protection Bureau has been shrunk dramatically. So you may struggle a little bit here If there's a legitimate dispute on your credit report, though, you did not apply for credit, you should at least have it should be suppressed for fraud. Like that inquiry should not go out to somebody else. And I've been a victim of business and personal credit identity theft, so I know how the inquiries are the first sign of what's going on, and the inquiries actually were a little bit more difficult for me to get addressed. So just keep in mind that you have the right to dispute it, keep good records because it should be suppressed at least if it's fraud, someone actually applied in your name, or if it's a mix-up, it should probably be removed. All right, so before we go into the resources and questions here, what about credit repair? So, I am a little bit more agnostic about credit repair than some who are in the world of credit advocacy. And the reason is because I understand credit's confusing, it's overwhelming. And if you aren't going to do anything at all and you're not going to get back on track, that's probably not always a great strategy. So sometimes people just end up working with, credit repair firm because it's easier and they don't understand or don't have the time. You're building a business, you don't have time to deal with it. Okay, I accept that. What I don't want you to do is think that the credit repair organizations have some secret or I don't know, something that an insider knowledge about how to do this. Yes, they deal with credit, but it's not something you cannot do on your own or can't learn on your own. And sometimes I see consumers spending a lot of money and then not really getting long-term results because they haven't really figured out this whole just how the system works. And they're still making the same mistakes with their credit that they made before because they don't know. And so they have high utilization or they're applying for credit too often or whatever it may be that is not getting them ahead. So I would say do what you can. If you're going to work with a credit repair organization, do understand they cannot legally do anything you cannot do on your own. I have been to the credit bureaus. I have walked into the mail room at Experian and seen just walls and walls of mail delivered by credit repair organizations that are disputes they just dispute, and hope that the information does not get confirmed and gets removed. It's not the only thing they do, but it is their number one go-to strategy is disputes. And it's easier than ever to write those letters. So understand that. All right, so let's go into questions. Before I do, I did mention we have a guide that we've created at NAV. You can see the QR code there if you want to download that guide, and it's a little bit of a workbook type format where you can do a checklist. So you can look at the strategies that might work for you, and hopefully you will find that helpful and that it's completely free. And I'll mention quick what NAV does. NAV is an all-in-one dashboard to check, manage, and monitor your business and personal credit in one place, and then get tools to build a financially healthy company. Now, you can sign up for an absolutely free NAV account that's free forever. And with that, you can get some overall general insight into your business credit health and your personal credit health. But if you really want detailed credit reports, you want the credit scores, and you want a trade line that will help you that will go on to your business credit reports and help you to build business credit, that does require a paid plan, and those are the build and expand plans. You can find more at nav.com. But again, you can always start out just for free. The other plans will give you more details and will give you the opportunity to start, building some business credit as well. All right, so that's what I had to cover, Rachel and Amanda, and I think Amanda's going to check our questions. So let's go into the questions, and I'll stop sharing. So Rachel, if you want to put something back up, you can.
All right. Thank you, Gerri. That was wonderful. I hope everyone is enjoying the webinar so far. We do have a couple questions that have been dropped into the Q&A portion, and if anyone has additional questions, you can drop them in to the chat or the Q&A. We have a couple questions here from Patrick. Patrick is wondering, Gerri, is there a way to start a credit score for your small business corporation instead of everything relying on your personal credit score?
Yes, so you can build business credit separate from your personal credit. You do not have to have good personal credit to do that. So we have talked about that here before with another webinar. And I know, Rachel, I think you had another webinar recently with Small Business Majority talking about that same thing. So you will see some resources in that guide that I mentioned to get you started on the credit building journey. And so you may want to download that and go through those resources. And then, Rachel, you may have more to share from Small Business Majority as well.
And then moving along, Patrick's next question was, is there any way to negotiate a lower payoff on a high balance business credit card without negatively affecting your credit score?
Um, it will be very unlikely that you can negotiate a lower balance on a credit card without negatively impacting your credit score. Part of that debt will be forgiven, it will be charged off, and that will be reflected as a charge off. So that's typically negative information. Now, depending on your financial and credit situation right now, I will say that there are some SBA loans that can be used to refinance debt, business debt. So if you have a business credit card that was used for business purchases and you can qualify, you might be able to use an SBA loan, like the example I gave earlier in the webinar, to refinance that debt at a more affordable rate and perhaps, work on getting that debt under control.
Janelle is curious, when is business credit used? I have built a Paydex score, but no one is asking for business credit. It's all personal.
Yeah, so business credit may be used by business lenders as well as for certain government contracts and commercial contracts. And I think one of the biggest hurdles of business credit is that it's not very transparent. So, unlike personal credit, where you kind of know that they've checked your credit because they tell you, they have to tell you by law, they don't tell you with business credit. So, your business credit may have been checked in different transactions that you don't even know about. So, it depends. But yes, and supplier credit is also typically more business credit checks than personal credit checks. So again, these resources are in the book, and we should probably try to focus on personal credit in this presentation because we did a separate one on business credit. But if you have more questions about that, you'll see Nav in the e-guide, and you can always reach out to Nav's team. They're very good about answering questions like this.
Kimberly has a question. I do understand your explanation on the formulas and how they differ from each one, FICO versus Vantage. But why are the scores so different by 50 to 100 points each? And can you get them closer?
Yes, that is a great question, Kimberly. And there could be a couple of reasons. One is that some of the Vantage score models more recently are focusing on what's called trended data, as opposed to the traditional credit score as a snapshot in time. They're looking at what's on your credit report when they calculate your credit score. Vantage score is moving toward trended data, looking at, well, what was your balance last month, 6 months ago, I guess up to a year ago. So that may be one factor that's impacting you. Another factor is just some of the nuances of the way they treat things like a closed account, where FICO, when you close out account, that balance is no longer available. But the credit history is still going to count. You still had that credit card for, I don't know, 12 years. That still counts. Vantage Score is more likely to treat that as just it's a closed account. We're not going to look at it in any detail like we would the other ones that you have. So there's some factors in there that matter. Now, I will say, although Vantage Score has made major strides in the past few years in their adoption, FICO is still the most widely used. It produces the most widely used credit scores. So if you're going to focus your energy, focus it on, building good, making sure your credit data is accurate, making sure that things are paid on time, keeping your balances low. And then if you want to look at score factors, I would probably focus on FICO score factors first, just because there's probably a higher probability, especially in the business context. There's a higher probability that's what the lender is going to use is a FICO score of some type. So I guess what I don't want you to feel is so overwhelmed that you're trying to get every number to a certain number. My suggestion is you focus on the factors, the underlying factors, because that tends to help no matter which credit score is being used.
Okay. Thomas has a couple questions, so I'm probably gonna do a multi-point question here.
Okay.
So I noticed that you can freeze or pause your account with a specific creditor. Does that help with anything? And then, does debt like Klarna, OnePay, etc., how do those debts or inquiries work for or against you?
Yes. So let's start with the credit freeze. So it's like freezing your credit card, right? So you're locking
Mhm.
your credit card. That's just for purchases. If you don't have any activity for a while, that affects your overall, activity of your credit report. So an account that's inactive for too long may either be closed by the issuer, and then it may drop off your credit report eventually, but it depends on the issuer, how long they want to see if you're ever going to use that credit card. So I wouldn't worry about freezing it, locking it in terms of just locking it from use and then unlocking it when you need it, if that's what you're asking. If you're asking about freezing your credit reports, that doesn't affect your credit scores. It just is a little bit extra work if you need to use credit, right? You need to apply for credit, so you have to thaw it, lift the freeze, unlock it, whatever they call it, depending on the company, and then you apply for credit. On the BNPL, the buy now, pay later side, there is an effort to bring that information into the credit scoring ecosystem, but I'm going to be honest with you, it's not widely adopted yet and not widely used. Things in the credit scoring world take time. So they'll be very wary of this when you see an announcement like we're unveiling this new credit scoring model. That's great, but lenders are slow to move, especially banks and especially traditional lenders. They are slow to adopt new models. They have to reprogram the whole systems. They have to test the risk. It's not something to do fast. So BNPL is not really a big impact on your credit right now. If you are relying heavily on BNPL as a financing, method, then it sounds to me that's something where you may want to get some financial advice just to help you move away from that so that you can use things like 0% credit cards or lines of credit where there might be less risk than something like a BNPL, which can get expensive, over time.
Daryl asks, can you do a balance transfer from a personal credit card to a business credit card?
Technically, the agreement tells you can use it for business purposes. So if you had a personal card that you use for business purchases, you could transfer it to a business card for business purposes. Yes, I would keep good records because accounting wise, that could be tricky. So I would talk to your accountant to make sure that they're okay with you doing this, and that you have documentation that those were business purchases and not personal. I would not put personal purchases on your business credit card if at all possible. While no one's looking over your shoulder, your agreement does say you will use it only for business purchases. And if you ran into trouble and couldn't pay it back, that could come back to haunt you.
And Don is asking, I'm getting 300,000 from a lawsuit, but not yet distributed. How can I guarantee a loan with a lien on my lawyer's escrow account? I'm anxious to get my business going.
That's an interesting question. I don't know a lot about those loans that go against legal settlements. I mean, they're out there. I really don't know enough about them to advise you one way or another. I would just make sure you look at the cost, of course, right? Because that's going to be your biggest risk there is the cost. And then I would also make sure that you understand whether there are tax implications of that settlement, because if you're going to pay taxes on it, you don't want to have a loan that's bigger than the tax bill that you owe or bigger than you can pay, once you pay all the taxes.
All right, we are going to do one more quick question since we need to wrap this up. If your child opens their own credit card and you remove them as an authorized user, will that reset the child's credit age if you had had them as an authorized user on one of your previous cards?
Oh, I love that question. That's a great question. So the question is will that credit history disappear? And the
Hmm.
answer is probably not because it's not, typically it will just stay on the credit report for a period of time. Eventually, yes, it will drop off, but for the time being, it probably will continue reporting. Every issuer has its own policy. So that's one thing you could just call the issuer and ask them, if I remove them as an authorized user, will you remove it from their credit or not? The process when you're an authorized user to actually get removed and then get it off your credit report is a little bit complicated. So I don't think it would happen that easily, but it doesn't hurt to ask. Great question.
All right. Well, that's all the time we have for all those wonderful questions. Gerri, if you want to wrap everything up, you and Rachel.
Yeah, thank you, everyone, and thank you, Rachel. I'll let Rachel say have the final word.
Thanks, Jerry, and thanks, Amanda, for y'all's partnership and y'all's wonderful presentation. Just want to give a reminder that this webinar was recorded today, so you will receive a copy of the recording and a copy of the slides at the email that you registered with. But stay tuned for more events from Small Business Majority and be sure to check out NAV's website. And we hope you all have a great afternoon.
Thanks, everyone.